for countries around the world.
It's our declaration of economic independence. For years, hardworking American citizens were forced to sit on the sidelines as other nations got rich and powerful, much of it at our expense. But now it's our turn to prosper.
Traditionally close ally Britain gets a 10% tax on exports to the U.S., the EU 20%. Ursula von der Leyen is head of the European Commission.
The global economy will massively suffer. Uncertainty will spiral and trigger the rise of further protectionism. The consequences will be dire for millions of people around the globe.
Marketplace's Nova Safo is here with me with more.
Yeah, here's some other trading partners and what they're facing. Vietnam, think clothing and shoes, 46%. Import taxes on Chinese goods rise to about 54%. Markets are reacting. To get a sense of the mood, we spoke with Jeremy Swan. He's with the financial advisory firm CohnReznick.
The tariffs that were announced were much more substantial than people expected. When you look at, the U.S. and you look at the global markets right now, the expectation is that this is, it's going to have a significant inflationary impact within the U.S.
Now, Swan's hoping some of the bigger tariffs can be negotiated down, but worries that the 10% across-the-board tariff is here to stay. And there are fears of a trade war igniting as well because countries are preparing retaliatory tariffs, David.
Now, Nova, most economists tell us that tariffs lead to higher prices here, which consumers pay. What are you saying?
Yeah, well, we put that question to the Yale Budget Lab. It's been calculating the potential impacts of the various Trump administration tariffs. And to add it all up, here's the Budget Lab's Director of Economics, Ernie Tedeschi.
So everything that's been announced so far would come to about $3,800 per household per year. Roughly a $3.1 trillion tax increase over 10 years. And that means an increase in prices of 2.3% over the next year.
And Tedeschi also says expect U.S. economic growth to slow as well, David.
Marketplace's Nova Safo, thank you. Dow futures are down more than 1,100 points, 2.4%. S&P futures are down 2.8%. NASDAQ futures are down 3.8%. Germany's key stock index down 2% now, with some financial firms like Barclays now seeing a, quote, high risk of a U.S. recession this year. Global demand for energy would drop, and the price of crude oil is down nearly 5% now. U.S. government bonds are up, pulling the 10-year interest rate down to 4.08%. The dollar's down sharply, with the euro on track for the biggest one-day jump in a decade. Now to China, which has vowed countermeasures. Marketplace's China correspondent Jennifer Pack spoke to a factory owner who makes shoes mostly sold to the U.S.
China's Shoebot manufactures athletic shoes for small and medium brands. Over half of its clientele are American. The firm's CEO is James Gao. Short term, he says, the latest tariffs might be positive for China's shoe manufacturing because for the past few years, big shoe brands have been shifting production to Southeast Asia. He says now that tariffs on countries like Vietnam, Cambodia, and Indonesia are 30 to over 40%, it might not be that much cheaper for companies to shift away from China because industry experts say China is still the most efficient place to manufacture shoes and at a higher quality. As for the future, says Gao, the American government is highly volatile, he says. After speaking to his U.S. clients, they've agreed to wait for a month and see how things go. In Shanghai, I'm Jennifer Pack for Marketplace.
Marketplace Morning Report is supported by Amazon Business, dedicated to helping businesses save time on office tasks and empower leaders with business buying solutions that support teams to focus on growing the business. Learn about smart business buying at amazonbusiness.com. And by Sold a Story, investigating how the education system got reading wrong and takes you places getting it right. Sold a Story, available in podcast apps.
Amid recession talk, the U.S. labor market had been running strong, and a report from the Dallas Fed says it's sectors like healthcare driving this. Here's Marketplace's Elizabeth Trovall.
Among labor economists and monetary policy wonks, Luke Pardue with the Aspen Economic Strategy Group says there's still an open question.
Why do we still continue to see that really strong jobs growth relative to pre-pandemic levels when the Federal Reserve just went through this whole tightening cycle?
The Dallas Fed report had an answer. Job growth has happened in sectors that are less cyclical.
Sectors like healthcare or the federal or state governments aren't as sensitive to interest rates because they don't need to rely on investment or sort of credit. In this post-pandemic time, a lot of the employment growth is coming from areas that just aren't as responsive to interest rates.
But there are other theories about labor market resilience. Economist Vivi Chari is with the University of Minnesota.
What looks like strength is just the normal process of recovery from the very sharp decline in employment that occurred during COVID period.
But he suspects there's also something else at play.
Certainly, strong employment growth is probably due to the unprecedented surge in immigration.
The conference board's Mitchell Barnes agrees.
Immigration is a key piece to this puzzle. When you really just look at the population growth that we've seen, that is not only adding to the worker pool, but that's adding to households, adding to spending.
Immigrants increase the demand for products and services. Barnes says public investments during the Biden administration also supported the labor market.
I think there are some one-offs where you start to look at some of the policy impacts that are underlying these numbers. Non-residential construction, potentially a beneficiary of a lot of that federal investment, has been, pretty strong over that same time.
He says for each sector, there are different reasons for resilience. I'm Elizabeth Troval for Marketplace.
Stock index futures are pointing to a surge down today. S&P futures now down 3.4% in Los Angeles. I'm David Brancaccio. Marketplace Morning Report from APM, American Public Media.